Another market review. Yes, we're doing one so soon after the last one because, well, markets are moving. So I figured I'd update you guys a little more frequently because I feel like people only care about looking for information when the market is going down anyway. Everybody's a genius when the market goes up like this. But yeah, we're gonna do our review today, figure out where markets are headed from here because they seem to be continuously dropping. And at the end, I got an interview for you with one of the greatest traders to ever do it. This interview is actually hilarious. You need to stick around for it. So we'll play that right after we figure out whether we're in crash territory or not. And as always, if you haven't taken our free training yet to learn the strategy that we're using in these markets, then do that now. There's a link in this video and down below in the description and comments. Like I said, this market is falling, and this is where you really need risk control if you don't have it already, and that comes through in your strategy. That risk control is why our strategy hasn't taken many losses, even though the market is down, over 10% now? We're still up over 55%. It's not magic, just risk control. And if you want to learn more about how we're doing it, myself and all our Fallible members, definitely check out this training. So 3 weeks ago, if you've been watching these videos, we were talking about the 10% sell-off, and that just happened yesterday. I'm recording this Friday morning, early morning. So what we said all those weeks ago and what we're still saying now is that this is a short-term move lower. It's just a short, I would say 10 to 20% correction. But the risk reward greatly favors the upside and an eventual punch through the top side of this broadening top pattern, which you can see right here. It's interesting when you zoom out on these charts because you can actually see the market may not be moving the way you thought it was. It's actually within a huge range. But as we're saying, we think it could break out from this broadening top right here, and then you'll have, again, the massive bull going. But the near-term path over the next few weeks really hinges on the fiscal stimulus talks, because that's what this market is moving on. You think it's moving on the fundamentals of the economy? No, of course not. It's moving on how much money the government and the Fed can pump. And that's why it goes back to fiscal talks. The fiscal stimulus is what fueled this rally off the March lows, and it's what's needed to drive the market up and out of its 3-year trading range. This being the 3-year trading range here. Now, if we don't get another $1 trillion worth of fiscal stimulus, then we're going to be in trouble because we're going to see a lot of large-scale layoffs and companies going under, especially if we run into this fall period where a second wave of COVID comes through. Nobody really knows how the CCPV is going to go during this period. So if those worst case scenario things happen, then we're likely going to see extended sideways volatile movement. So just trading within the range again. Now, we talked about this before, but a big thing that we're looking at are the monthly bars. So you can see September, we've had a pretty bad month. We're getting a fat bear bar. And a signal like that means that in October, we're likely going to head lower. Now, because we had these 5 bars before here that were bullish, the downside is probably a little capped because eventually buyers will come in because they see a deal. But yeah, you can see the bar a little better right here. It does not look good. So we'll likely print another bearish bar in October. We'll see though what happens. There's still a few trading days left in this month. We might recover a little bit. But if we're really getting into the technicals here, it looks like we're stuck under this 50-day moving average now. We pretty much sliced through it. You can see here we had some support, which is what the 50-day normally does because everyone's watching it. Rebounded a bit, but then turned around and headed lower immediately and sliced through. So that next support level could be this 200-day moving average, which means a correction of how much? Another 3.5%, 4%. That would bring the total correction to, let's see, 13.5%, which is nothing crazy really. And it's completely possible. But again, because of these prior months, any real weakness will likely be bought up. And if you're wondering why these lines changed, it's because I just switched from the daily to the monthly chart. And now say this yellow line is going to be a 50-month moving average versus if I go to the daily, it's a 50-day. A little bit how charts work on this platform. So that's what we got to watch into next week. Like I was saying, that monthly candle. Bulls want to get the market above its August lows, which would be right here, that 3270 level. But bears would want to close near the September lows. So they'd be happy if we stayed around right here. But depending on how you look at it, like if we move over to the Nasdaq right now, you can see we might be putting in a little short-term double bottom here. You can see this candle on the 21st, it had a very low wick that retraced back up. Same thing happened on the 24th, and you can see their lows were right around the same area. And when you see action like that, the thing falling and then being bought up, that probably means there's a little support right here. So this might be the bottom forming, and you can see this kind of rounding out here. So will we move higher from here? Maybe, or maybe we'll go sideways. But when we're looking at the Nasdaq, it might be less likely that we're going to go and fall down to the 200-day moving average. So again, we need more data and more days to see how this plays out. So putting it all together, we get a mixed picture with odds favoring more bouncing around action. This fits with the developing fiscal talks, which saw some renewed life today, with both Mnuchin and Pelosi announcing some renewed interest in pushing ahead. People are skeptic about whether both sides can get a deal done before the election, especially after RBG's passing. But Alex, our lead researcher at MacroOps called up one of his old DC buddies, because Alex used to be FBI and all this counterterrorism stuff, lived in DC. It was a fun time, but he's got buddies over there, and one of them is a lobbyist, so he had some good information about the talks. By the way, I'm on the last season of Veep right now, and that show is just so good. Even though I hate anything to do with politics in Washington, and it really turns me off, this show is funny enough to overcome it, especially Jonah Ryan right here. Watch that on HBO if you haven't already. Okay, but here's what the DC guy said. He said the passing of RBG changes nothing. In fact, it gives those working on the talks some welcome cover from the constant news attention, which was hurting them. Too much spotlight, they didn't have time to do any work. But who's really doing any work in DC anyway? There's actually a number of Democrats with tight races coming up, and they'll definitely lose their seats if they leave Washington without getting a deal done. So they're freaking out, and they're willing to make big concessions to get that fiscal stimulus passed. The Trump administration is playing coy in public, but they're actually pushing for the stimulus too. They want a deal closer to the range of the Democrats at over $2 trillion because it's definitely going to boost Trump's re-election odds. And there aren't any Republicans who are going to try and challenge it other than, complaining about the deficit because they're a Republican. So the odds are roughly 75% that they agree to broader terms of a package that's north of $1.5 trillion within the next few weeks. There's a real threat of the major airlines running out of emergency funding by the end of this month. And if that happens, then you're going to have tens of thousands of workers that are going to be furloughed as a result. And that's one more reason why we're likely going to see a deal sooner rather than later. These are all voters. You can't let them lose their jobs. Not that they actually care about them losing jobs, just their votes. So that's an inside scoop, and it definitely runs counter to what we're reading in the press. But our DC friend has a pretty good record with these things. And this more constructive fiscal take, if this stuff does get passed, well then that's going to affect the long dollar thesis and the short gold swing trades that we made in the MacroOps portfolio. We released a note a few days ago talking about gold, and I know a few of you were asking about that. So we can go over that real quick. So there's two forces that shape price charts. There's trending action and then reversion to mean. And that's all price action is. So nothing ever moves in a straight line for long. And that's because price becomes so extended from the average entry price of those who are early into the trend, who bought in early, that they start to take profits. And at the same time, those who like to fade those extended moves, who want to short, they see that large gap between the price and the moving average. And that's all moving averages are, right? They're averages. Not magic that things get pulled back to, but it just gives you an idea of where the buying happened. So anyway, those guys who see that gap, they start to enter counter trends, so they short. And that drives bouts of mean reversion, profit taking and shorting. And you can see this on any trend. Any chart you look at, you're going to see this type of price action. We actually go into depth about this in our price action masterclass, which we actually go over with this strategy. But anyway, in a trend, if there's still gas left in it, if it's going to be a longer term trend, then price will retrace to that average level and investors will find enough value again to enter and then drive the next leg of the trend higher. That's where you'll see this up-down pattern with the general trend still going higher though. Now, a popular moving average used by traders on shorter time frames is the 21 moving day average. Larger funds look at longer term averages because they're not day trading or swing trading. So they're looking at the 200 day. They don't like to buy too high above that 200 day or sell too far below it. So different time frames looking at different averages, this kind of drives the large swings and counter moves within larger trends. So here is a 35-year price chart of gold and its percentage gap from the 200-day moving average, which is shown right below here. So over this period, gold has hit trend extension levels of 25% or more from its 200-day moving average only 6 times, including its most recent buy climax. You can see all of them marked right here. And we hit that again recently a few days ago. So a 25% spread from its 200-day moving average is a rich level like we talked about. When you're looking at that, it might be some time for some mean reversion. So the last time it happened, 5 other times, 86, 2006, 08, 09, and 11, we had drawdowns. And then we had a number of trading days until we hit new highs again. You can see there's a big range in how long it took to break to new highs again, but it's an average correction of 26%, which has taken an average of 648 trading days to regain new highs. Or if you exclude the outlier in 2011, then the average is 21% down and 255 days back to new highs. Now, based on that, we put a short on the position, a short-term short though. Gold was 10% down from its peak, and if we see an average retrace of 25%, then it should trade below 1700 in the future. And at that point, it'd be below its 200-day moving average, and traders would see a bargain and then enter back in. So that would be a lot more downside from here. But like we were saying with the fiscal talks, if those pass, then this whole trade might get blown up. So in the MacroOps portfolio, we're currently short. So that's the thing with these shorter term trades, you really got to watch them. And Alex is playing the mean reversion here. But long term on gold, he's very bullish. So again, what we were just talking about, this whole mean reversion thing, it's short term. And that's what mean reversion is most of the time. I mean, it depends on what time frame you look at it in. But say within in a larger trend like this, then yeah, any mean reversion is a short-term play. And our views on the dollar are still the same. Dollar going lower, gold is going to go higher. So to sum up markets right now, the longer-term risk reward greatly favors the upside because of underpositioning in risk assets. And we talked about that before, right? The big hedge funds and institutions, they have not even put their money in the market yet. They are very low on equity exposure. So there's lots and lots of cash on the sidelines that's still got to come in. And that's why even with action like this, we're still long-term bullish. But with the short to intermediate term, it's more muddied. We're likely to see more vol and chop. And we're kind of on standby until we figure out what's happening with this fiscal stuff. There's only a few trading days left in September, and that's where the month and the quarter close. So it's going to be a big tell on where supply and demand pressures are heading into October. Remember, the broader you go out in time frame, especially on the monthly or even quarterly, the better signal you're getting. We don't know what's going to happen going into the end of the month, but if I had to bet, I'm going to say we'll head lower. But thankfully, I don't need to predict where the market is going because we got our strategy right here. It's got its risk control in place. We're making great gains, and all we got to do is sit back and execute. Don't really have to worry about which direction the market is going. And that's the way it should be. So if you're stressed out and trying to figure out all this stuff, don't worry about it. Just take this training, use the same strategy we're using. It's way easier and more effective. And it's not BS either. It's a real professional strategy, and that's why it's easier. But check it out. There's a link in this video and down below in the description and comments. And speaking of the strategy, one of the parts of the strategy is an active portfolio, meaning we make more trades. And I was getting a number of emails over the last month saying, hey, why are there no active trades going off? Because this is a systematic model, right? I'm not saying buy this, buy that. It's just a model that runs. So the people who are new to this strategy, they were saying, hey, what's up with the active portfolio? Aren't there supposed to be more trades going on? Well, here's the thing. With this strategy, we're never going to force any trades. And when you get a market like this, like look at this action right here, it's going straight up. There's no chance for you to even enter any of the stocks because the way the active strategy works is that it waits for a dip in particular names and then jumps in. But if the market's going straight up like this, when's the dip going to come? And no, it's not some buy the dip strategy, but it's understanding certain price action within the context of larger momentum in a broader trend, which actually goes back to exactly what we were talking about with mean reversion. That's what it works off of. So it takes advantage, jumps in, and then profits. We just did that with Zoom. Zoom had this dip. We were able to get in with this active strategy. Then it shot higher and we took profits. But you need that dip to get in the first place, at least for this type of strategy. So again, in any strategy, you can't just be forcing trades. You need to take what the market is giving you. And that's where the patience comes into play. If you're out there forcing trades, you're just going to lose money. You need to stick to your system and execute it. And yeah, you might go through a stretch where you're not getting any trades, but that's how the market goes. Feast and famine most of the time. All your profits come in a small period of time. The rest of the time, you're just trying to hold on. And that's with most strategies. So anyway, I've been getting a lot of questions about that, or at least I did, until, as you can see, we've been getting a lot of active trades getting put on. And again, you want to learn more about all this, it's all on this training. And now finally, let's get some advice from one of the greatest traders to ever live. Way smarter than me, way smarter than you, way smarter than everybody. Let's see what the legendary Greg Reba has to say.
They hit me at the mark, by the way. All I know is when I first walk in, every mother, can I say fuck, has a Rolex on their hand. And I'm like, looking at it. That's all I could think about when I first started trading. Everybody's got more on their wrist than I got in my account. I thought it was just like, you know what, I could beat these guys. And I figured that 99% still don't get it. When you win, you start betting less. Bet more. I mean, there's one roll that you can make $100,000 off. Let it ride. If you roll 3 6s in a row, let it ride. Let it, the winner's ride. Money gets you super checks. I'm talking about the Playmate. Isn't that what every guy's dream is? Right? The other thing about trading is just don't lose money. When you lose money, it changes everything. You can't keep going losing money and expect to live the same life. Somehow God or somehow some spiritual thing just whacks you. Or you want to buy something expensive because you've made it, and you've made enough money to buy it. You start losing every day. You buy a house, you can't make any money anymore. You go on an expensive vacation, but as soon as you say you're over the hump, I don't know.
How do you deal with that? How do you deal with
I didn't have to make money every day.
Did you make money every day?
For a long time, yes.
What happened? You don't trade now. Do you trade now?
Cut.
There you go. Greg Reba. Let it ride. Don't lose money. It's that simple. That's all you got to do in the stock market. This is such a classic interview. I don't know if you guys ever saw it, but now you have. But okay, take the training and don't forget to subscribe to our channel. I'll see you in the next video. Stay fallible out there. Bye.